Hi, I'm Mark King, investment editor at Columbia Threadneedle Investments, and here's what's in my weekly column. Well, inflation in the UK rocketed to 2.9% in August, up from 2.6% in July, according to the Office for National Statistics. It said rising fuel import costs, as well as rising food and clothes prices, has led to the rise in the cost of living. The Bank of England meets this week to consider whether it should raise interest rates in the UK, but with ongoing Brexit negotiations leading to much uncertainty about the future health of the British economy, it's not thought likely that rates will rise despite the spectre of inflation. This will mean Britain's savers continue to receive relatively poor rates on their cash savings accounts, as there are no savings accounts on the market that currently pay a rate that will match or indeed beat inflation, according to Moneyfacts. The real value of people's savings then are being eroded by the everyday cost of living. And simply put, with inflation at 2.9%, £100 will be worth just £92 in 3 years' time if left in one of the many accounts paying just 0.1% interest. Meanwhile, the August inflation figure indicates that prices are rising faster than wages in the UK, with wage growth shrinking since the beginning of the year. Thus, the pressure on household finances increases, which makes it even more important that you look closely at your personal finances and investments to check your money is working as hard as it can for you. But it's not all doom and gloom, of course. Continued low interest rates are good news for homeowners with mortgages, as it's likely their repayments will remain at historic lows. Also this week, I look at the Financial Conduct Authority's decision that investment firms can continue to use an assumed annual growth rate of either 4.5% or 5% when they provide customers with projections indicating how their holdings might perform over the medium to long term. The FCA also states that in these projections, inflation should be assumed to continue at around 2% a year. As such, the typical investor holding a portfolio dominated by equities can reasonably expect to earn a real rate of return of 3% a year before tax. Now clearly, that seems low in the context of this week's inflation announcement, but the projections are not meant to be taken literally. Projected returns are perhaps most relevant when you're investing for a specific goal, such as for your retirement or to cover your children's university expenses. Projections allow you to apply a range of potential average annual growth rates to your investments to see how much money you might be able to amass in, say, 10, 20 or even 30 years' time. By assuming a range of projections, you can calculate best and worst case scenarios for how much your money will be worth by the time you reach your goal. But do remember, these projected growth rates are not a guarantee of fund performance. They're simply a reflection of what the regulator currently thinks are reasonably likely rates of return on a typical investment portfolio. See you next week.